when somebody comes to you and they're speaking the way you speak, if you ever notice there's somebody who walks up and you're like, my God, I feel like I've known this person my whole life. I just vibe with them. I gel with them. Chances are they speak in the same preferred communication style as you, and you just gel together. So in real estate, what we like to do is when it comes to negotiations, we teach the students, you've got to be watching people's body language, listen to the words they use, listen so that you know what's important to them in this negotiation.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 420. My guests today have developed their own unique systems and formulas for investing in multifamily. And today, they're going to discuss joint ventures versus syndications, the three core roles of multifamily investing, and their 5 cornerstones of a thriving multifamily business. Jen and Stacy Conkey have over 2 decades of investment experience and are the founders of Remote Multifamily Investing Academy. They're also co-authors of the book, Multifamily Freedom Hacking, which is available on Amazon. Jen is also an NLP Master Practitioner and business strategist, and I'm looking forward to learning more about her NLP methods. Jen and Stacy, welcome to the show.
Thanks, Brian. Thanks for having us.
Thank you, Brian.
Where should we start? Multifamily. Tell us how both of you kind of started investing in multifamily. Where did that begin?
Back in 2002, my brother came over to my house. He lived around the corner from me at the time, and he said, hey, come with me to the store. So I got in the car with him. We started driving around, and he started talking about flipping for profits. I thought he was crazy, didn't know what he meant. 6 hours later, I was hooked. I was at his house, and we were developing a business plan so that we could flip for profits while still working at our normal jobs. So that's how I got started. I started with flipping single family homes. And then I literally started doing buy and hold of single family homes and then 2 to 4 unit size properties all the way until I met Stacy. So I was for 12 years working in corporate America at Target Corporation, TRW Safety Systems, Home Depot. I learned a lot at Home Depot, especially when it came to contractors and building. So that helped with rehabs. I really was just grinding it out in my own backyard for 12 years. And it felt kind of alone. And whenever I would hit a bump or a hurdle, I always longed for somebody else or a community of people that might be going through what I was going through and ask questions, because my family thought I was crazy. They were like, why are you doing this? You're already making multiple 6 figures. You got bonuses and stock options. And why would you mess around with this? But I just always knew it was something that, wow, once my brother showed me, the rest of our family thought we were nuts. He ended up giving up. But I met Stacy in 2015. She had already been coaching people. She was so good at it. She'd been coaching people one-on-one. And she was like, hey, you know what? I do this joint venture thing. And I was like, oh, I want to know about that. And she was also talking about remote investing. And because I had been scrambling so hard in my own backyard, I was like, man, I want to know how to do that. I've got to date her more often. And so I could learn about it. And so that's how that came to be. And then I'll let her tell her side of the story. But we eventually started using her joint venture approach to go into smaller apartments versus jumping straight into syndication, which is what I wanted to do. But then I found out how expensive it was to get started. So
Jen, explain just briefly what joint venture versus syndication, like in 30 seconds, what's the difference?
Well, syndication, it's a securities offering, and you have to have a private placement memorandum. A securities attorney requires a lot of money up front to get started, if you will. And then you go and you offer, whether it's a 506B or C, you offer and you raise money from limited partners. But a joint venture, you're just finding somebody to actively do the deal with you. And they might be coming in with the deal. They might be coming in with money. They might be a credit partner, but we all have an active role. And it cuts through all the red tape of having to go through a PPM and a securities attorney and all of that.
And then Stacy, bring us up to speed on your background in multifamily and how you got started.
My journey started just a little over 20 years ago. And I ended up reading Rich Dad, Poor Dad after going to a Tony Robbins conference and getting very excited about life and Anyway, so I read that and I was like, oh, that is so logical. My background is accounting, so I like things that are logical. And I was like, oh, you bring this rent coming in and you have these expenses and there's cash flow. Yes, I want that. How do I do more? So that's what just kind of got me started. And I lived in Sacramento, California at the time, which, as a new investor, I was just full of excitement and enthusiasm. And I didn't really understand market dynamics or anything. But what I found in practice was that it was a very difficult place to begin, not only location wise, but price wise. Prices were very high there, so which required a lot of capital to get started, which I didn't have. And then on top of it, just to compound it, the market was very hot at that time. So like, good luck even finding a deal. And if you could find a deal, it takes a lot of money to put it together. So it felt like a lot of roadblocks. So fairly early on, I met someone who was a mentor of mine who taught me about investing remotely. So I learned how to do that and started right away, got into small multifamily, like residential multifamily, 2 to 4 units, ended up opening a property management company in Detroit. I moved to Detroit, started a property management company. And that was where I really started to learn about larger multifamily by taking over people would buy a building and then hand it to me for management. And I learned so much about multifamily from that side. So moving into it as an investor was natural. At that point, I'd done 30 or 40 deals of smaller properties. So that was my journey. That was my journey into it. And I was focusing on joint venture because I would just do smaller apartment buildings, up to 30 units where I could, find maybe 2 or 3 people who, would, generally speaking, they'd be the ones putting in the capital. I'd mostly be doing the majority of the work, but everyone would have some active role so that we would be doing it together. And it not only helped me with building my portfolio, but it helped them get started and build confidence and build credibility so that they could go and find deals and be able to say, oh, I already have a 10 unit or I already have a 20 unit. And it made getting funding easier and getting deals easier from brokers.
Are you exclusively just doing joint ventures or have you done syndications as well?
Yeah, we've done syndications now. And we ended up learning how to do syndication. What was it, 2016? Yep. 2016. And I was like, oh,
very beginning.
Yeah, I was like, this sounds pretty cool. And then we were like, wow, oh my goodness, this is a lot more complicated than we realized. So, we still ended up doing it, but we just recognized we really had a nice niche for just continuing to acquire smaller properties up to 30 units through joint venture. But then we did move into syndication in, what was it, 2022?
Yeah.
2021? Anyway.
2021.
Yeah. And so we've been doing syndication since then. But my preference still is, and will probably always be, joint venture because, wow, it's the syndications. You can make a lot more money in syndication. There's no doubt. But it's, it's a little bit more stressful because the amount of money you have to raise is significantly higher. But if there's a place for both, my whole thought on it is when people are just getting started, I see a lot of people, they want so badly to get started in real estate. And when they only know one thing, they only know syndication, because that's what most people talk about. Most people never actually get started. And that it's not right. Like everybody should have the opportunity to get started and build a portfolio of passive income. And we've just learned over the years that people can get started so much easier if they'll start with something smaller that they can raise with a couple of people and then build the credibility and the confidence and then stair step into syndication. So
we've even had a few people that have only known syndication. They didn't realize that you can still do acquisition fees when you're doing it joint venture. So they were very surprised. They were like, oh, I didn't know that I could do it that way. So
Explain that. So if you're joint venturing with someone and they're bringing in the money, you structured in such a way that you're also receiving an acquisition fee at the same time?
It depends on the deal. So every deal is a little bit different. And if the deal is too skinny to be able to charge an acquisition fee and give our joint venture partners a return that would make them want to do the deal, then there's just not room for it. But when there is room for it, when the deal is really solid and we can give them a killer return and we can do an acquisition fee, then we will build that in. Because just like with a syndication, it is still a lot of work to go from researching markets all the way through closing a deal, even a joint venture deal. It's not that a syndication is so much more work, there's more complication. But when we can fit it in, we do. And we're completely upfront with our partners about it. Mm-hmm. And they know, they're just like, well, heck, I'm happy to not have to do all of that. So that's cool. As long as I'm getting the return that, that I want, we don't mind. So we're very upfront about it. We're upfront about the amount of work it is also, so that hopefully they're not feeling like, well, I don't know. We've never had anyone balk at it.
Stacy, you mentioned Detroit. I'm curious where you both are located now, where you're investing. Are you still investing remotely? And kind of what is your niche that you're investing in? I like the type of apartments or multifamily.
You know what, Brian, it changes over time depending on what's going on in the economy. So right now, the only deals that we'll even consider are ones that are stabilized, which this is different than even 2 years ago, but we will only consider ones that are already stabilized, cash flowing on day one, but with upside, with value add components, which, that's a little bit of a unicorn. We're closing our second one of those on January 3rd, and our third one of those that came later, but is closing before the end of the year.
December 29th.
Yeah, just December 27th is the last business. Anyway,
right.
Towards the end of the year, we'll close that one. But those are not that easy to find, but that really is our niche. I tend to err on the side I'm very conservative. I went through 2008. It was a very difficult and painful time. I wish to never go through anything like that again. So we've been paying really close attention to the trends to make sure that we adjusted our strategy when the economics started changing too.
So what size properties are you buying and where are you buying them?
Right now we're going to close on a 13 unit, a 48 unit. We're really, our sweet spot is 35 to 55 doors right now. That's just our strategy. And where we're going, well, we have two different models, two different things that we're doing. So we have our academy where we've literally trained people that bring us deals and we do deals with them. So there are acquisitions teams that bring in deals and then we'll do deals with them. And then we have our capital company where we also raise capital for other syndicators. So we do intend to start raising capital for Hunter Thompson, who's getting a lot of multifamily properties in Phoenix.
Yeah.
While we're also looking at a couple of people that have peers in Raise Masters. Bryce, he's got opportunities for us with mobile home parks that we could raise for. So we have so many different types of businesses, but for a multifamily property, what we really love right now, our sweet spot is 35 to 55 doors. It's a smaller raise. And right now it takes a lot to raise capital. It's just because there's uncertain times. So you have to use a different type of model when going into these times. So we're doing smaller raises on smaller buildings, doing as much joint venture as we can. But when we do syndicate, which one of those is a syndication, our 48 unit is a syndication. It's right in the sweet spot, 35 to 55 doors, purchase price anywhere from 5 million to 10, maybe 15 million. And then trying to do raises that are 2.5 million or less. That's our sweet spot right now. Only fixed financing. Not a fan of the variable. We actually have nobody in our life that took a variable right now because we've been coaching them through not doing that, knowing that what goes down in interest rates is eventually going to come up. And it didn't expect it to come up that quickly, but because of that and because of the uncertainty, we're only going for fixed rate debt. So the 48 unit is agency financing, which we love, we prefer. And or seller financing.
Yeah, the 13 unit is a fun one because it's 20 storage units and 13 units. And the seller is 89 years old. Oh my God. I would never have known it talking to him. He's extremely sharp. And he's just like, it's a great building. And, I need to make plans. But he's like, I don't want to give up the cash flow. So we ended up negotiating seller financing with him and he's thrilled. I mean, we're thrilled. It was 5% interest, which didn't seem that sexy 2 years ago. Now we're like, that's so sexy, 5%.
Right.
Yeah. So we love seller financing whenever we can get that.
How are you able to talk him into or kind of persuade him to do seller financing?
We really didn't have to. His broker, he's the one who wanted it. And his broker was the one who basically said, well, this would be an option. So really it came down to, oftentimes sellers aren't already, you do have to have a conversation. You have to show them how it's such a huge benefit for them. But in this case, we didn't actually have to do that because the broker, listening to his client and understanding what his needs were, had suggested to him, why don't you do seller financing? That way you can continue to get cash flow. You're going to end up making more money on it. So all that we really had to do was negotiate the terms. And he was, we thought we were going to be negotiating, but everything that we offered, which the point was to offer low because knowing he was going to, negotiate somewhere in between, he was just like, okay. Okay. So it feels like it actually feels like he's a partner instead of just a seller financing. It feels like he wants us to win. When the inspection came back, the building was in great shape. There's, a lot of little things that were wrong. And our partner who was like kind of doing the negotiating, she was like, what things should I ask for? I said, just ask for everything. Well, one, he might come back and negotiate, but honestly, I think he wants to provide us with a really good, solid building that doesn't have problems from day one. He's going to want to fix these things, I think. Sure enough. He was like, oh, yeah, I'll fix it all. Great.
I want to make sure we hit on the things that I mentioned in the introduction there. The 3 core roles of multifamily investing, what are they?
So for us at our academy, we teach that there's an acquisition manager, a capital raiser, and an asset manager. Those are the 3 primary roles. And we teach when people come to the academy, we try and figure out what are your skill sets. So an acquisitions manager is sort of like the CFO of a company. They're just focused on how to underwrite, how to analyze the data, how to look at, is this a solid, viable market? Am I going to be profitable here? What do all the trends look like? So they're the ones that are going out there, finding the best markets. They're getting all of these relationships. So you do have to be able to make some phone calls, find some brokers, and get deals starting to come in. They analyze about 25 deals a month, and they're making about 1 to 2 offers a month on apartment buildings. And once they lock one up, we have capital raisers. So they'll have someone on their team that, hey, we post the deal, capital raisers, this is an opportunity for you, come raise capital, this is the raise. So they have all their relationships, and their role in the deal is that they are investor relations for anybody that they bring in to invest. The asset manager is the one who really manages the asset for the entire hold period and makes it as profitable as possible by increasing the top line as much as possible to get the return for those investors. But those 3 roles work as a team. And as a team, they have the bandwidth to do 2 to 3 deals a year versus trying to do it solo. Obviously, we want them to all know the entire process. But once they know the entire process, they identify which role is best suited for their skill set so they can soar with their strengths, get in that lane, stay in that lane, and be as productive as possible. And then they work as a team doing 2 to 3 deals a year. So we have a mission at our academy. I want 300. I want 100 teams of 3. So I want 100 asset managers, 100 acquisition managers, and 100 capital raisers so that we can all do 2 deals a piece, which would be about 200 deals a year, cash flowing at about 100 to 150 per door. Could be, $3 million in cash flow a month that we can do some serious damage with, and then eventually continue to buy assets, turn it into a REIT, and become billionaires. Like we have a massive vision.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. Where are you in that plan?
Right now we have 75. So we're always recruiting for more. We take the best of the best in the academy and continue to nurture them. So for that 13 unit, it's one of our students brought it to us, and she was negotiating, and Stacy was consulting and training her through it. So there's a good opportunity for us. We've watched our students for 2 years get into deals and how they conduct themselves following our process. So we feel very confident in their abilities. We haven't seen them take shortcuts. We haven't seen them, have bad business practices. So we watch them for 2 years, and then we kind of tap them on the shoulder and we say, hey, we think you're really awesome at this. Why don't you go find us a deal and we'll do it together? And then we'll be able to consult you and teach you and coach you a little bit one-on-one throughout that deal. And it's fun because they're growing, we're having fun, and then they're a team for us. So it's like we've literally cloned ourselves which is that's the dream, right? Because we have way more reach because we've cloned ourselves and we treat the academy like a farming system. And then their life is getting much better as they continue to acquire more doors and build their cash flow and their wealth. It's just really fun. But those are the 3 roles: acquisition manager, capital raiser, asset manager.
I also would love to know what the 5 cornerstones of a thriving multifamily business are.
Sometimes it feels like it's a linear process. And for your first deal, it is. So the very first one is you have to acquire the property. So once you acquire, and there's a lot of things that go in that. So building the relationships, getting the deal flow, analyzing it, learning that whole skill set. But acquiring the property is in and of itself an entire process. Once that property is acquired, the next step is you've got to stabilize it. You've got to get it under wraps. You've got to execute the business plan. So stabilization. In order to do that, when you're acquiring the property, you're building a team. We have boots on the ground. We teach people how to do this remotely from anywhere in the country. So managing that team, we manage property managers because we hire third-party property management to come in and run it so that we don't become burnt out landlords. So part of it is, so the first one is acquiring the property, then stabilizing the property. And the third is managing the team. So for example, 96 unit that we closed in March earlier this year, we had a stabilization plan that we needed to execute within that first quarter. So every week we were on the phone with the property manager going over what was needing to be done. Where were we on it? And so managing the team is that third process. And then you've got the fourth one is you've always got to be raising. You have to be raising capital constantly raising capital, which is why we believe in the 3 roles. So there's always a capital raiser on your team who's out there, or maybe 2 or 3 who's out there raising capital, networking, going to in-person events, going to virtual events, meetup groups, whatever it might be, but constantly attracting accredited investors that are interested in investing the money that they don't really have time to spend. They don't even have time to go actively invest. They just want to invest it because they keep making more. So you always have to be acquiring new leads that you can help them get a return on their money. So the 4th one is raising money. The 5th one, and this one's the most important, is as you acquire property after property after property, after about 3 to 5 years, you've now got quite the asset list. And at some point, you've got to be able to manage your portfolio. So manage the entire thing, meaning you got to know, like, every 6 months going into what markets you're in and assessing it. What's going on with the job population? What's going on with crime rates? What's going on with migration? Are people coming in? Are they leaving? What does it look like? And what's going on with the value of the property or rents, market rents? And should I be increasing rents? And by how much? Should I sell? Should I refi? There's so many different ways that you need to look at each asset and make some critical decisions, because if it's an opportunity where interest rates like 3 years ago were super low, refinancing would have been awesome, as long as you didn't do it on a variable rate. But it would have been awesome to get into a lower fixed rate so that you can pull some money out and go get another asset. So that's really the most important one, is now that you're flipping all these properties into your asset list, how do you manage it as a business and a portfolio and constantly making critical decisions to keep scaling and keep growing?
We've reserved some time here toward the back half of our conversation to talk about NLP. And it's something I'm always fascinated with. And Jen, I know you're a practitioner, a master practitioner. So can you explain to our audience what it is and how you use it?
So NLP, it stands for neuro-linguistic programming. It's just a fancy way to say language. So communication, it's all about communication. So 7% of what we communicate is in the words we use. 38% is the tonality or how we say it. And then 55% is our body language. So if I'm looking at somebody, and this is how it applies in real estate or actually in any area of life. If I'm looking to get into rapport, so rapport is basically getting into like a likeness with one another. And it's understanding that communication is about responsiveness, and whoever can get the other person to respond wins. Now, not that this is a competition, but if I'm communicating with you and you're not understanding what I'm saying, I'm listening for what are some of the predicate words. Do you say things like, hey, check this out, look over here, I want to show you these things. Those are words that indicate you're a visual person. Or if you're saying things like, hey, listen up, did you hear how Tom over there was saying this? That means you're probably auditory. Or if you're saying things like, I just got to wrap my arms around this and get a conceptual feel for what this is all about, then you're kinesthetic. So I'm constantly listening to the words people are using so that I understand how they best take in information, because I want to adapt to that. I can pick it up pretty quickly. Also, body language tells me. So When somebody's sitting up tall and, they're talking really fast and they're going like this and they see them, they're breathing, they're very much visual because they think really quick and they're moving. Somebody who's more kinesthetic is probably going to be, slouching a little bit or kicked back a little bit, and they're going to talk a little bit slower, and they might even take a little while to finish their sentence. That's when you've got somebody who's kinesthetic. And the auditory person, they're kind of all over the place, but they'll say things to themselves, or as they're answering a question, they'll be like, what's that again? Oh, yeah. They talk to themselves to answer themselves. So when you know somebody's preferred communication style and you adjust to it, the thing is that as human beings, we relate well to people who are like us, and we'll listen, we'll be more attentive because they're speaking like us. So we will hear them and we will understand them, because if I'm somebody who's talking very slow, but you're talking really fast at me, I'm like, calm down, right? So when somebody comes to you and they're speaking the way you speak, like if you ever notice there's somebody who walks up and you're like, my God, I feel like I've known this person my whole life. I just vibe with them. I gel with them. Chances are they speak in the same preferred communication style as you, and you just gel together. So in real estate, what we like to do is when it comes to negotiations, we teach the students, you've got to be watching people's body language, listen to the words they use, listen so that you know what's important to them in this negotiation. For example, the owner, Andy, of the 13 unit, he's 89. He wants to retire. What was really important to him was having the cash flow up until then. He doesn't know what's going to happen in the next 10 years. He hopes he sticks around. But knowing that about him, going into that negotiation, we can create a win-win situation because we're identifying what's important to him. We also know what's important to us. And there's a way to negotiate and come to a compromise. You can do the same thing when you're pitching to an investor, pitching your deal to an investor. What's important to them? Do they need cost seg? Do they need to offset some income? What do they need? Do they need cash flow? Is the cash on cash return most important to them? But how do they speak? And then speak in their terms. So predicate words are a big one. If you hear somebody saying things like, I see what you're saying there, or I hear you, or I can feel that. I feel that right here. You can very quickly identify what their preferred style is, and then try to match and mirror their tone and the pitch and the cadence at which they're speaking, and even matching their body language. Because if they're really relaxed and you're like this and leaning in, it might make them feel a little off, right? So, but if you match them and you're in their energy bubble, have you ever had anybody come up to your energy bubble with tremendous fury and you're like, oh my gosh, I have. And I'm just like, oh my God, calm down. Like I'm in the middle of something and you just popped my bubble.
I'm standing right here.
Stacy all day. Stacy's very visual and I'm very kinesthetic. And when I get on a podcast, I try to vibe so that I can match up. But if somebody comes into your energy bubble with their energy and not yours, there's a lot of friction. But if they come in and their bubble and your bubble's just sitting there floating and they float up, it's like, this is awesome. But if you're like going through things and they just come up and they're like, oh, I see you're working there. Like it's matching energy with energy. And so you're going to get more rapport with them. That's really just like the 101 of it.
Where would you go to find out more information about NLP? Like how could you learn how to use that?
I would go to my trainer, my coach, Dr. Matt James at NLP.com. So I went through him years ago. He's very good. And he all over the country, he has it's integrative neuro-linguistic programming. It's INLP training program. That's his entry level. And then he has master practitioner status, and he does all kinds of other things with energy work. And he'll even train you how to train people on it. It's a very, very good program. I would recommend that one the most. And learning that is such a good skill because not only does it help with your communication and your relationships with others, but it helps with your relationship with yourself because you'll hear that inner monologue. You hear yourself saying those things. And when you change your language to something more positive, because the unconscious mind, it doesn't hear the word not, like I or don't. It doesn't hear, I don't want to be late today. All it hears is late. Or I don't want any problems. All it hears is problems because you're focused on the word problem. So it's trying to solve things for you. It's very interesting though. So I would definitely go to NLP.com and it'll bring up the empowerment partnership with Dr. Matt. He owns NLP.com. That's how big he is. And it's very good training. Very good training.
Stacy, I'm wondering, I always ask this question to my guests, and Jen, you just shared a lot of great stuff about NLP. Stacy, what is your favorite life hack or app that you use all the time?
One of the things that actually Jen introduced me to it, but a few months ago was the 100-Day Journal by John Lee Dumas.
Mm-hmm.
And that, there's probably like lots of little life hacks, but that one has been really transformative for how I can fit everything I want to do. I have a lot of goals, and not so much. We have 4 kids, and we have our portfolio and deals that we're trying to close, and our academy. There's just a lot going on, and I struggle with how do I get everything done. I have a big mission on earth. I want to make a huge impact, but there's only so many hours in the day, and it gets a little bit overwhelming at times for structuring that. So that 100-Day Journal really has helped me to figure out, well, what are the top 3 things today? Like the 80-20 rule. Mm-hmm. What 20% of things can I focus on that will give me 80% of the results? And the way it's outlined just helped me to really, okay, well, what are the 3 things? What is the one big goal for 100 days out? And each day it gets, closer and closer. And it really keeps you laser focused on whatever the thing is that is the most important or impactful for your business at the time. My big struggle is there's always more than one, but that journal has been great. And I think it was like, what, $20 or something?
Yeah, it wasn't that. I think it's like $14, $12.
Yeah. And it was on Amazon.
It's the best.
Yeah. We're about to buy the next ones for us and our COO so that we can all kind of stay on the same page and really move all of our businesses forward with focus. And that has felt really good instead of being like, oh my God, there's so many things.
Yeah.
That's the 100-Day Journal, and it's John Lee Dumas who puts that out. Also hosts the Entrepreneur on Fire podcast.
Right. Yes.
Exactly.
So how would people find out more about both of you? Please feel free to talk about your business and your coaching program as well.
So if you're an active investor or want to be an active investor, meaning you want to go out there and be a part of the general partnership, find deals, and then go raise capital, the best place to look is at probably our academy website, which is rmfia.com. Right?
No. RMFIacademy.com.
Oh, yeah. RMFIacademy.com. Sorry. RMFI. It stands for Remote Multifamily Investing Academy. So RMFIacademy.com. And then if they're interested in passive income or investing passively with us, investing with us in our deals, what's the URL for that one? I know she curated a beautiful list for the passive investor to go learn and get a foundation.
Yeah. Well, the one that I created was really for active and passive, but no matter what, it's a great place for people to go to get a foundation. Because even if you're going to invest passively, you really should know what you're doing. You should know what you're looking at. You should understand about multifamily. Don't just put your money into a deal because you like the people who are talking about it. But that is, it should be up by the end of the week, but it's www.warriorsofwealth.com. And we have multiple trainings that we've done over time because we've done tons of free education and it's high quality education. And we just made it available to the public so that we could serve and educate people. So warriorsofwealth.com, and there's, I think, 8 short masterclasses in there, between 15 and 30 minutes each on all of the major topics that we feel are important for people to get a really good solid foundation so that they can, whether they're going to move forward actively or passively, they're getting a foundation. But on that one, I think it has somewhere on there that you can schedule a call and talk to us. If you're looking for passive investing, that's a great place to go and get to know us a little bit, learn a little bit so that you're coming in as a knowledgeable investor, which is what we require of our investors, that they at least are sophisticated with the knowledge.
Warriorsofwealth.com.
Jen, Stacy, thanks for coming on the show today and talking about multifamily, the core principle or the core roles, the 5 principles. Very interesting how you approach it. And Jen, I really appreciate the breakdown of NLP, neuro-linguistic programming, which is always fascinating to me. Thank you so much for coming on the show today and sharing this with us.
Thank you.
Thanks, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.